Hello, and a very good start to the week. Today we talk about pizza. Let's go.
It is definitely the right way to kick off a Monday, but I actually have to warn you right out of the gate here.
Yeah.
We aren't really talking about pizza today.
You know, you always say things like that. I'm looking at the ticker symbol DPZ. I'm looking at the box with the red and blue domino on it, and I'm pretty sure they sell pepperoni and cheese.
They do. They definitely do. But that is just the surface level. If you actually dig into the 10K filings and the strategy documents we have in front of us today, Domino's is something else entirely.
Okay, I'm intrigued.
Yeah, it's a high-tech logistics firm and a supply chain monopoly that just happened to use pizza as the vehicle for its software.
That is quite a bold claim. I mean, it is Monday, February 23, 2026. We have autonomous taxis driving around San Francisco right now. We have AI writing code. And yet you're telling me one of the most compelling investment cases on Wall Street is a company that makes dough.
Precisely because they act like a tech company. And, I'm not the only one saying this. We are looking at a company that has attracted over $1 billion from Berkshire Hathaway over the last 18 months.
Wow.
Right? Warren Buffett's team, they don't buy just pizza. They buy moats.
Okay, so let's unpack this for everyone listening. We have a massive stack of source documents here. Financials from late 2025, real estate heat maps, regulatory filings. Our mission for this deep dive is to figure out why this invisible giant is beating out tech stocks.
And why, paradoxically, the less you see of them, the more money they make.
Yes, let's start with that visibility issue. Because I was looking at the real estate data in our notes, and it just doesn't make sense to me.
How so?
Well, if I'm a retail brand, I want to be where the people are. I want Times Square. I want the Loop in downtown Chicago. I want downtown San Francisco. But when I walk around those areas, I just don't see Domino's.
You don't. And honestly, if you did see them there, it would actually be a red flag for their investors. This is what the industry calls the density paradox.
Explain that. Because in my mind, high foot traffic equals high sales.
In a traditional restaurant, yes, absolutely. But Domino's isn't a traditional restaurant. Think of it more like a distribution node. Let's look at the data we have from Las Vegas versus Brooklyn.
Okay.
Las Vegas is this sprawling, car-centric city. Domino's absolutely loves it. They have about 5 stores for every 100,000 people there.
Okay, so they heavily saturate the suburbs.
Exactly. Now look at Brooklyn. Super high density, tons of pedestrians, very cool reputation. Domino's has less than 1 store, specifically 0.9 stores per 100,000 people there.
See, that seems like a massive missed opportunity. That's millions of hungry people walking right by.
It's a math problem. To be in those cool, high-density areas, you have to pay what we call prestige rent. You're paying a premium for the visibility, the big signage, the foot traffic.
Right.
But Domino's whole model is built on ruthlessly low overhead. They don't want the fancy corner. They want a strip mall in a suburb with cheap rent. And most importantly, 15 dedicated parking spots.
For the delivery drivers.
For the fleet. Their stores are essentially small factories, maybe 1,200 to 3,000 square feet. They don't have dining rooms.
None at all.
No. Even what they call their pizza theater design. It's just a waiting area for pickup. In the industry, we call them dark kitchens with a front counter. If they pay $300 a square foot for a location in Manhattan, the economics of a $7.99 pizza just completely fall apart.
So they're intentionally avoiding the glamour locations to protect the profit margin.
They are purely an asset-light operator. In 2026, the storefront isn't the physical building with a neon sign. The storefront is the app on your phone.
That makes total sense.
Yeah, 85% of their U.S. sales are digital. If the customer is ordering from their couch while watching Netflix, why would you pay millions for a billboard in Times Square?
You don't need curb appeal if you live in the cloud. I get that.
Yeah.
But this brings us to the strategy from the sources that I found the absolute most controversial. Fortressing.
Ah, yes. This is the absolute core of their domestic strategy.
It sounds so aggressive. Fortressing, like they're preparing for a medieval siege. When I read how it actually works, it sounded more like self-sabotage.
It does create a lot of friction with the franchisees initially. Here is the setup. You have a Domino's store that is absolutely crushing it. High volume, great sales. The local franchisee is very happy.
Naturally.
And then corporate comes along and says, we want you to open another store 3 minutes down the road.
Right, and if I'm that franchisee, I'm flipping the table. You're going to split my customer base in half. You are actively cannibalizing my own sales. Why on earth would anyone agree to that?
Because you aren't looking at the unit economics of the delivery driver. You have to look at the delivery times.
Walk me through that math.
Okay, let's say you have one store covering a really large suburban radius. A driver, let's just call him Gary, has to take a delivery all the way to the edge of the zone. It's a 12-minute drive there and a 12-minute drive back. That's a 24-minute round trip.
So Gary can maybe do 2 delivery runs an hour once you factor in the loading time at the store.
Right. And remember, Gary is paid by the hour. Now, if you fortress the market, meaning you intentionally split that territory in half with a brand new store, Gary's average drive is now maybe 6 minutes there and 6 minutes back.
Oh, I see. So now he can do 4 runs an hour.
Suddenly, your labor cost per delivery drops by nearly 50%. You are getting double the productivity out of the exact same driver.
Okay, I see the operational efficiency there. But you still cut the overall sales of the first store, right?
You do. The same store sales usually take a small hit immediately after fortressing, but the total cluster profit goes up.
Because of the speed.
Yes. Faster delivery means hotter pizza. Hotter pizza means happier customers who order more often. And there is a secondary benefit to fortressing that is actually even more important.
Which is what?
Carryout. The carryout business is the highest margin segment because you don't have to pay Gary to drive it to a house. Domino's found that when they open that second store nearby, 80% of the carryout business at the new location comes from brand new customers.
Oh, so people who just wouldn't have bothered driving the extra few miles to the old store.
Exactly. They are unlocking invisible demand. And by putting a store every 6 minutes or so, they completely choke out the local competition. If you are an independent mom-and-pop shop, or even a Papa John's, you simply cannot compete with a delivery network that dense.
It's like a blanket over the city.
And it also blocks the aggregators, like Uber Eats.
Because Domino's keeps all their deliveries strictly in-house.
Right. If they control the last mile with this fortress density, they don't need to pay Uber or DoorDash a 30% commission. They completely own the logistics.
It's playing offense by playing defense. I can definitely see why Buffett likes that. It's a literal moat made of pepperoni.
It really is.
But let's shift gears to the money. Because even with all this brilliant efficiency, selling cheap pizza is a really tough game. Margins are usually razor thin in the food business.
And that right there is the biggest misconception about Domino's on Wall Street. If you buy shares of DPZ, you aren't really buying a pizza seller. You are buying a supply chain monopoly.
The toll booth model.
Yes, the toll booth economics. Domino's corporate generates roughly 60% of its revenue, not from royalties on sales, but from selling the physical ingredients to its own franchisees.
Wait, so if I open a Domino's franchise, I can't just go down to Costco and buy bulk flour?
Absolutely not. You are contractually obligated to buy your dough, your cheese, your sauce, your cardboard boxes, and even your employee uniforms directly from Domino's corporate supply centers.
That feels, well, is that even legal? It sounds like they have a totally captive audience.
It is pure vertical integration. And while it sounds restrictive, the franchisees generally accept it because Domino's is actually really smart about how they structure it. They have a profit-sharing agreement.
How does that work in practice?
The Domino's corporate takes 50% of the pre-tax profits from those supply chain centers and actually rebates it back to the franchisees.
Okay. So they are basically saying, yes, you have to buy your cheese from us, but we will split the earnings with you at the end of the day.
It perfectly aligns the incentives. It guarantees consistent quality. So a pizza in Idaho tastes exactly like a pizza in Maine. And it gives corporate this massive, steady stream of cash flow that isn't dependent on the day-to-day volatility of selling a single pie to a customer.
It's incredibly stable.
Extremely. In the first 3 quarters of 2025 alone, this supply chain machine generated nearly $500 million, $495.6 million to be exact, in free cash flow.
$495 million in free cash flow. That is the kind of number that catches Wall Street's eye. And they don't have to spend that money building new physical stores because the franchisees pay for all the build-outs.
Which leads us directly to Omaha.
Yes, the Berkshire Hathaway position. We've been watching the 13F filings roll in, and it wasn't just a one-time splash, was it?
No, it was a very methodical accumulation. They started buying back in the 3rd quarter of 2024 and continued for 6 straight quarters right through the end of 2025. They were buying in calculated tranches.
And the final stake is massive.
It is. They currently hold 3.35 million shares, valued around $1.4 billion. But the number that tells the real story is the percentage ownership. They stopped buying at exactly 9.92%.
That's incredibly specific. Why stop at 9.92? Why not go for 10% or 15% if they love the company so much?
It's the regulatory line in the sand. Once you cross that 10% ownership threshold, you go from being a passive investor to an insider in the eyes of the SEC.
So you have to file different forms.
Extra paperwork, extra scrutiny, you have to file Form 3s, Form 4s, and you become subject to the short swing profit rule.
Which means?
Meaning you can't buy and sell the stock within a 6-month period without paying any profits back to the company itself. It's a massive headache for a fund like Berkshire.
So stopping at 9.92% is basically Berkshire saying, we love this business, we completely trust the management, and we just want to sit back and collect the gains without doing the extra paperwork.
It is the ultimate vote of confidence. It means they see this as a long-term compounder. It checks every single Buffett box. Highly predictable cash flow, strong moat through scale, asset light, and a management team that aggressively buys back its own stock to return money to shareholders.
It really does sound like the perfect investment. But before we get too carried away with all the praise, we do need to look at the other side of the coin. Because while the U.S. is clearly a well-oiled machine, it's also kind of full.
Yeah.
I mean, how many more pizza places can we actually squeeze in here?
That is the big growth question for Wall Street. And the answer isn't in the U.S. anymore.
Right. We're going to take a quick break to give a shout out to our community. But when we get back, we are going to look at the international engine, which operates completely differently from the U.S. model, and we'll dive into the two massive risks threatening to derail this entire train in 2027.
The debt wall and the weight loss drugs. We definitely can't ignore them.
Stay tuned. If you like what you're hearing today, we invite you to subscribe to the channel, leave a like, and comment on what topics you would like us to address in future episodes. In the description of this episode, you will find the PayPal link in case you want to support this project. Your contribution helps us a lot to continue making content like this. We ask for no more than the cost of a coffee. Thanks for your support. And we're back. So we've established that Domino's USA is a highly efficient fortress. But looking at the growth rates in our source material, the U.S. is growing at a compound annual growth rate, or CAGR, of only about 3%. That is pretty sleepy.
It's a mature market. They have effectively saturated it. If you want the real growth, you have to look at the over 14,000 stores outside the United States. That international sector is exploding. It's growing at over 8% TAGR.
But operating a food brand in dozens of other countries sounds like an absolute nightmare. You're dealing with different labor laws, completely different local tastes, volatile currency fluctuations. How does Domino's manage all of that without massively bloating their corporate headquarters?
This is the genius of the master franchise model. Domino's corporate doesn't actually go to India or China to run things. They find a massive, sophisticated local company and just hand them the keys to the kingdom.
So they essentially outsource the entire country.
Effectively, yes. Let's take India, for example. It is currently Domino's biggest market outside the U.S. The operator there is a company called Jubilant FoodWorks, and they are a publicly traded giant in their own right.
So Jubilant takes on all the operational risks.
All of it. They hire the local drivers, they build the supply chain centers, they negotiate the real estate rents. Domino's corporate just provides the brand name, the software technology, and then they sit back and collect a royalty check on every single sale.
Wow.
Yeah, if the rupee crashes or if there is a massive labor strike in Mumbai, that is Jubilant's problem to solve, not Domino's.
That is incredible risk transfer, and I assume Jubilant knows what Indian customers want to eat much better than a corporate guy sitting in Michigan does.
Exactly. That's why you see menu innovation abroad that would never happen in the States. In India, for example, the Pepi Paneer Pizza is a massive bestseller. They have adapted the spices, the vegetarian options, everything to the local palate.
And I assume it's the same exact story in China.
Yes, with a company called DPC Dash. They are aggressively building out the store network in major Chinese cities. And again, Domino's corporate is just the technology partner and the brand licensor. They have successfully turned global expansion into a high-margin royalty stream with almost zero capital investment on their end.
It creates this amazing flywheel. They get the explosive growth of an emerging market paired with the stability of a U.S. blue-chip stock.
Exactly.
But let's go back to that technology partner idea you just mentioned. We talked about the digital app earlier, but there was a specific feature in the notes called pinpoint delivery that really caught my eye.
Yeah, this is where they really flex their tech muscles over the competition. Pinpoint delivery allows you to order a pizza to a GPS coordinate.
So not a street address, just a little spot on a map.
Just drop a pin. Maybe you are sitting at a specific bench in a massive park, or you're hanging out at a spot on the beach. The delivery driver navigates to the exact GPS pin, not a building.
It sounds a little bit like a marketing gimmick, but I guess it really removes friction for the customer.
It completely removes the address barrier, and more importantly, from a corporate perspective, it gathers invaluable data on where people actually congregate. It helps them map future demand in places that don't even have zip codes. It just reinforces the whole idea that they are fundamentally a logistics company, not a restaurant.
However, we have to look at the storm clouds on the horizon. It is 2026. The world is changing incredibly fast. You mentioned two big risks before the break. Let's start with the financial one, the debt wall.
This is the one that definitely keeps corporate CFOs up at night. Domino's runs with a lot of debt. That's actually how they fund those aggressive share buybacks we love so much. But they have $1.3 billion in debt maturing in mid-2027.
And that specific debt was taken out years ago, right? Back when interest rates were tiny?
Right. They're paying a very low rate, about 4.2%, on that money right now. In the current economic climate of 2026, refinancing that massive chunk of debt is not going to happen at 4.2%.
It's going to be substantially higher.
Much higher. Imagine if your monthly mortgage payments suddenly jump by 40 or 50%. That eats directly into the profit margin. That beautiful free cash flow machine we talked about earlier gets a little less efficient if hundreds of millions of dollars are suddenly siphoned off just to pay higher interest rates.
So that is a very known, very calculable financial hurdle. But the other risk we found in the sources, this one feels almost existential, the GLP-1 factor, the Ozempic effect.
This is the massive cultural shift. By 2026, weight loss drugs like Ozempic, Wegovy, and Mounjaro are completely mainstream. Current estimates suggest around 12% of the entire U.S. population is actively using these.
And these drugs, they literally turn off the craving center of the brain.
They kill the desire for high-fat, high-carb, salty food. Honestly, a large pepperoni pizza is the sworn enemy of the Ozempic user.
It's not just that they eat less pizza, though. They probably stop ordering all the high-margin add-ons, right? The lava cakes, the extra bread bites, the sodas.
Exactly. That is the ticket size risk.
Yeah.
Domino's relies heavily on you adding that 2-liter Coke and the Cinesticks to your order. If you're on a GLP-1 drug, you might just order one thin crust pizza for the whole family, and you personally might only eat one single slice. Shrinking appetites are a huge structural threat.
How does a fast food company fight human biology? You can't just market your way out of a drug that changes brain chemistry.
It's tough. They are trying to pivot. You see them highlighting portion control now, smaller serving sizes, rolling out high-protein chicken options. But fundamentally, if the overall population is structurally less hungry, that is a severe headwind for the entire fast food industry.
So we basically have a battle between two massive opposing forces. On one side, you have the fortress efficiency, the international growth, and Warren Buffett's backing. On the other side, you have rising interest costs and a physically shrinking American appetite.
That is exactly the standoff we are looking at for 2027. But for right now, looking at the 2026 market outlook, the efficiency is still winning out. Analysts expect revenue to cross $5.3 billion this year, and the target stock price range is sitting strong between $475 to $488.
It is just a fascinating case study. You think you know a consumer brand, you see the commercials on TV, and then you realize you're actually looking at a logistics algorithm with a cheese supplier attached to it.
That's the Domino's paradox in a nutshell.
I want to leave everyone listening with a provocative thought that came up while I was reading through the dark kitchen strategy.
Oh boy, what is it?
Well, if Domino's is proving so successfully that you don't actually need a dining room, and you don't even need a visible storefront on a busy street, and eventually, with the rise of autonomous vehicles, you won't even need Gary the driver.
Where exactly are you going with this?
Are we basically looking at the future of all food retail? Imagine a city where restaurants as physical places are just for the ultra-rich. A total luxury experience. For everyone else, our food system is just a grid of windowless fortress kitchens and industrial parks, dispatching calorie pods to our exact GPS pins.
That is a very distinct and slightly dystopian possibility. But efficiency usually wins out in capitalism, even if it eventually takes the soul right out of the dining experience.
Something to chew on next time you're tracking your pizza on the app. And with this, we reach the end of today's episode. We hope you liked it, learned something new, and will join us for the next one.
Thank you very much, and we will meet again very soon.
Remember that the PayPal link is in the description of this video if you want to help us. Thanks once again. Greetings.